Hello and welcome to the Daily Brief Show by Zerodha. In today's episode, I'll talk about four very interesting stories. In the first story, I'll talk about a new scam that may be breaking out in the stock market. In the second one, I'll discuss how the IPO party might be finally over in India. In the third one, I'll talk about how India's textile industry is benefiting from the Bangladesh crisis. And finally, in the fourth story, I talk about how the P2P lending sector is dealing with regulatory challenges. In today's first story, I wanted to discuss some trading and investment scams. Now, I know this is a little different from the stories we usually discuss, but I am talking about it because it is a big problem and I'm sure you need to be aware of it. Look, last week, a massive online trading scam was busted in Assam. 38 people were arrested for allegedly cheating people of 2,200 crore rupees. The scale of this fraud is mind-boggling, but what is even more alarming is that it is just the tip of the iceberg. This is the second scam in Assam in the last couple of months. In August, the Assam police uncovered another investment scam worth 7,000 crore rupees. The latest Assam scam, which ran for nearly 3 years, promised to double investors' money in just 60 days. Some victims even took out loans of 10 to 15 lakh rupees in order to invest in this scheme. At first, the scammers returned small amounts with 30 to 50% interest to lure people to invest even more money, and then they kept cheating them. What is shocking here is that the age of the mastermind, Vishal Pukran, is just 22 years. But this is not just an isolated incident. Across India, we're seeing a massive surge in sophisticated investment scams that are leading to investors losing thousands and thousands of crores. We can never truly know the true scope and scale of these scams because most victims do not talk about them publicly, but we still can have a fair idea. In just the first 4 months of 2024, Indians lost over 16,000 crore rupees only to trading and investment scams. I'm not even counting other scams like dating scams, loan fraud, etc. This is only and only trading and investment scams. So how are these scammers operating? Well, they're getting increasingly sophisticated and they often use social media and messaging apps to lure victims. One of the most common tactics is called pig butchering. Let me explain how it works. See, the scammer first poses as a financial expert or uses the identity of a well-known figure in the industry. They reach out to potential victims through platforms like WhatsApp, Telegram, or Facebook and offer insider tips or promise guaranteed investment returns. Now, in order to seem legitimate, they create elaborate fake profiles and even set up entire fake investment groups on these platforms. Imagine scrolling through Facebook and seeing an ad from someone who looks like a reputable financial advisor. You click on it and suddenly you are added to a WhatsApp group where people are sharing screenshots of massive profits they have supposedly made. It is all but fake, but it is convincing enough that many people fall for it even today. Scammers often use psychological tactics and create a sense of urgency or exclusivity to push people into making quicker decisions so that their minds are blocked. One of the more disturbing trends here is the use of celebrity names and even deep fake videos to add credibility to these scams. In Mumbai, for instance, there was a case where scammers used the name and likeness of a popular influencer. A 54-year-old real estate consultant from Mumbai saw what he thought were videos of a popular influencer giving stock tips. He ended up investing 2.25 lakh rupees and lost it. But perhaps one of the most shocking cases comes from Kerala. A businessman there was defrauded of more than 7 crore rupees by a scammer who posed as a representative of reputable firms like Invesco Capital and Goldman Sachs. These scammers are not just operating within India, by the way. Many of these operations have been tracked back to countries like Cambodia, Myanmar, Hong Kong, and even Dubai. Now, there is some small evidence that these scams might have something to do with China because some of the fraudulent web applications were written in Mandarin. Now look, all these scammers use different methods, but they are all prey on the same human desires, the hope for financial security and the lure for quick wealth. Some scams focus on cryptocurrency, others focus on stock trading. But now the question is, what can you do to protect yourself? Look, first and foremost, be skeptical of any investment opportunity that sounds too good to be true. Always verify the credentials of anyone offering financial advice or investment opportunities to you. Check if they are registered with official regulatory bodies like SEBI as well. Also, be wary of unsolicited investment advice, especially if it comes through social media or messaging apps. Never transfer money to personal bank accounts for investments. Legitimate firms, remember, do not operate that way. If you're using a trading app, make sure it is downloaded from official app stores only. Moving on to the second story of the day, let's talk about if the IPO gold rush in India is over. Look, the IPO markets have been red hot over the last 3 to 4 years and have followed pretty much the same trend as Nifty. After COVID, as Nifty rebounded from lows thanks to the bullish sentiment, private companies lined up to go public and the result was an IPO rush. From financial year 2020 to 2021, companies have raised over 3 lakh crores in IPOs. That is a huge number, and a good chunk of the IPO market craziness is because of the spectacular increase in retail investor interest. Now, I'm guessing you'd probably be curious over here about the investor behavior of IPO investors. Up until now, we did not have any data on this, but SEBI recently published a study to analyze investor behavior in IPOs. The study had some very fascinating insights, so let me give you some quick highlights. Now, look, even though for the longest time, market experts have advised caution before blindly applying for IPOs, the real truth is that IPO investors have done well for themselves in the recent years. The market has seen such a crazy bull run that it would have been nearly impossible to lose money in the last 4 years if you had participated in all IPOs and if you had received an allotment in all of them. But the problem is that people often overlook the fact that there is a much higher chance of getting an allotment in an underperforming IPO versus getting one in an IPO that is expected to do well. So the truth is that unless you were allotted shares in every single IPO, the high percentage of positive listings would not necessarily ensure that you made up net profit. Now, according to the SEBI study, 42.7% of all retail allotments were sold within just 1 week. HNIs and corporates exited 63.3% of their shares, and banks sold 79.8% of their shares within just 1 week of listing. But mutual funds, on the other hand, behaved a little differently and sold only 3.3% of their allotted shares in the first week. Now, this behavior, of course, varied slightly depending on IPO performance as well. But investors have also been more likely to sell IPO shares that showed positive listing gains, which is unsurprising. But to contextualize this for you, when returns were over 20%, individual investors sold about 67% of their shares by value within a week. And this is compared to just 23% when returns were negative. Now, some experts had been speculating that new investors who opened accounts after COVID-19 opened them only for applying into IPOs. The SEBI study also supports this. Nearly half the demat accounts used to apply for IPOs between April 2021 and December 2023 were opened after the pandemic. Earlier, high net worth individuals or HNIs could take massive loans from NBFCs in order to apply for IPOs. Shares were allocated to HNIs on a pro rata basis, which means they received shares in proportion to their application size, and this benefited those who bid larger amounts. But starting from April 2022, the RBI imposed a 1 crore rupee cap on such loans for HNIs. In addition, SEBI also changed the share allocation method from pro rata to a lottery system, which is similar to the one used for retail investors. Unlike the pro rata system, the lottery system randomly assigns shares and reduces the unfair advantages that HNIs used to enjoy earlier. Now, the result of this change has been quite positive. It has largely become less advantageous to apply for IPOs with large sums of money. This has led to fewer big-ticket, non-institutional investors participating and lower oversubscription rates. To contextualize again, the oversubscription rates in the non-institutional investor category dropped from 38 times to 17 times. Also, the exit rate of these investors within a week, which was SEBI's biggest concern by the way, dropped from 70% in 2021-22 to 25% in 2022-23. So overall, the regulators have successfully balanced market excitement with more well-judged investing practices, and this is great for our markets. And yes, I know many of these findings were probably very obvious to us, but we did not have data to back them up, which we now do, and that's great news. Now, moving on to the next story of the day, if you followed this show for some time now, you'll probably remember me speaking about how Bangladesh's recent political crisis has had ripple effects on multiple companies and industries in India. Indian companies with significant exposure to sectors like oil and gas, FMCG, auto, etc. were all impacted by the recent political crisis in Bangladesh. However, there is one industry that seems to be benefiting from this turmoil. It is the Indian textile industry. But before I get into the details, let me take a step back and explain Bangladesh and India's position on the global textile market scale. Now, according to a report by Care Edge, the worldwide ready-made garments or RMG industry was valued at 555 billion US dollars in 2023. In this massive market, China has been the biggest player for quite some time now, with over 30% market share. But what is interesting is that China's market share has steadily declined, which has opened up the market quite a fair bit. This is happening because there is a global sentiment around reducing dependence on China due to geopolitical tensions, trade wars, rising labor costs, and strict environmental regulations. In addition to this, the COVID pandemic exposed major vulnerabilities in over-reliance on a single source, and exporters no longer want to keep all their eggs in one basket. Bangladesh, which is the second biggest player with about 8.5% market share, was in the best position to close in on China. But because of the recent political turmoil, they are now facing some serious problems while meeting international orders. This has started to hamper their long-standing relationships with global brands and exporters. If this crisis continues for another couple of quarters, global buyers might seriously start looking elsewhere for more stable suppliers. And this is where India steps in with a chance to capture some of this shifting market. Sunil Kataria, who is the CEO of Raymond Lifestyle Limited, recently put it very interestingly. He said, and I quote, "The China plus one strategy and the Bangladesh plus one strategy, where global brands diversify their manufacturing bases, are now playing in India's favor." To give you some quick context, the China plus one and Bangladesh plus one strategy involves global brands diversifying their manufacturing bases by reducing their dependence on China and Bangladesh in the textile space. They do this to reduce risks and ensure stability in their supply chain, which usually leads to global brands expanding to countries like India. Now, the Indian government is also looking to capitalize fully on this opportunity. They recently announced an expansion on the Production Linked Incentive or PLI scheme to include textiles as well. This means companies will now get extra monetary benefits based on the amount of textiles they produce, encouraging them to manufacture more in India. Now, this scheme originally had an outlay of about 10,000 crore rupees, but it was limited to only specific type of fabrics. Now, in order to encourage production within the country, it is being opened up to manufacturers of all kinds of materials. In addition to this, there is also the recent PM Mitra scheme, which aims to create massive textile parks across India. The scheme could attract potentially 70,000 crores worth of investments and create 20 lakh new jobs. The government is offering some serious incentives here, including up to 500 crore rupees in development support per park. Now, the best news here is that it seems like all of these initiatives are starting to pay off already. To give you an example, the Tirupur Textile Hub in Tamil Nadu recently secured orders worth 450 crore rupees from major European brands for the upcoming Christmas season, and this is according to the president of the Tirupur Exports Association. The apparel exports cluster in Noida also saw a 15% increase in orders from fashion giant Zara as compared to last year. But all that said and done, all of this needs to be taken with a pinch of salt. Bangladesh will likely recover soon, and this boost for India may turn out to be a very short-lived one. Even if not, Vietnam, which is another major strong textile market in the world, has been giving some serious competition to us. Vietnam has a big edge over us because of its skilled but low-cost workforce and sustainable manufacturing practices. According to a report by Dragon Sourcing, Vietnam's workforce, despite improving wages, is still cheaper than that of China, which, by the way, is a big deal. Now, back to India, our textile industry has its own challenges to overcome. We still require some major technological upgrades and still have sustainability issues. If we truly want to capture the global export market, these are some hurdles we must cross as soon as possible. But on a positive note, if we do cross these hurdles, the potential is huge. If Bangladesh's crisis does continue, about 10% of its RMG exports could move to other markets like India. For context, this translates to a monthly export opportunity of 200 to 250 million US dollars in the near term and over 300 to 350 million US dollars in the medium term. Now, even though this would be a small addition to India's current $25 billion textiles market, it could be the start of much bigger things for us. Indian companies are also stepping up on this opportunity now. Big names like Aditya Birla Fashion and Retail, Monte Carlo Fashions, and Pearl Global Industries are among the 64 companies selected for the PLI scheme. So while the situation in Bangladesh is very unfortunate, it is creating an opportunity for India's textile industry. With the right moves from both the government and the private sector, India India could significantly boost its position in the global textile market. It is a complex situation with lots of moving parts, but it is definitely something to keep a watch on in the coming few months. Moving on to the last story of the day, let's talk about the P2P sector. Look, when RBI sneezes, some of the industry catches a cold, and this time it is the P2P lending sector. If you followed the show for a bit, you might remember our discussion in late August about the RBI's new guidelines that are shaking up the P2P lending sector. The aftermath is now here, and it is not at all looking pretty. But let me first give you a quick recap. Peer-to-peer or P2P lending platforms started with the promise of being alternatives to traditional banks, NBFCs, and sketchy money lenders. By the way, in case you have never heard of P2P platforms, you can think of them as Amazon's or Flipkart because they connect lenders and borrowers. The first generation of P2P platforms didn't really take off because they were just connecting one lender to another borrower. This did not work because the lenders had no ability to pick the right borrowers and defaults were really high. But then P2P platforms pivoted. Instead of just one-to-one lending, they split the money of the lender among hundreds of borrowers, thereby reducing default risk. They also started marketing P2P lending as an investment product and an alternative to fixed deposits and bonds. Now, some platforms even went to the extent and said that they will cover a portion of the losses and were offering credit guarantees. Over a period of time, P2P became a fairly popular investment product. The underlying product was essentially a bundle of loans, and people like mutual fund distributors started marketing it because P2P lending was given higher returns than debt mutual funds. But then last month, the RBI stepped in and pretty much killed the entire P2P lending model by issuing new guidelines. Here is a quick TLDR. But on August 16, the RBI issued new guidelines that threatened to put an end to most of these practices. Let me quickly explain what the new RBI guidelines say. First, they say that P2P platforms cannot provide any credit guarantees to enhancements. This means they cannot tell the lenders that the platform will cover or insure their losses. If lenders lose money, then they have to take the hit. Second, in the earlier model, if you as a lender invested 1 lakh rupees, the platform would automatically split the loan amongst hundreds of borrowers. This required just one authorization, but now the RBI says that every loan has to be approved and an agreement has to be signed. This means hundreds of OTPs, e-signs, etc. The diversification benefits the platform provided breaks. Third, as soon as the lender transfers the money, the platform has to send the money to the borrower in T+1 days, or else it has to send the money back to the lender. Fourth, P2P platforms also cannot promote peer-to-peer lending as an investment product with features like tenure-linked assured minimum returns, liquidity options, etc. Now, as you can imagine, these are some mega changes and they are bound to significantly impact the volumes. More importantly, the business impact can be reputational. So will lenders think that RBI is imposing actions because there is something wrong with the platforms and they will stop trusting P2P? In order to signal that it meant real business, just about a week after these new guidelines were issued, the RBI slapped a 4 crore rupee fine on two of the largest P2P players in India for not meeting disclosure requirements. This sent shockwaves through the entire industry, and many P2P platforms became scared of such heavy penalties and stopped onboarding new customers until they have clarity over the new RBI regulations and guidelines. Those who did not hit the pause button are now seeing a 90% drop in their businesses. By the way, it is not just the platforms, even customers are upset. Many had been promised instant withdrawals, but now thanks to the new regulations, that is become impossible. This puts P2P platforms in a very tricky spot, and it potentially violates their contracts with existing customers. What's also adding to the confusion is the industry-wide uncertainty about whether grandfathering of existing agreements will be allowed. In other and more simple words, will current customers still get the services that they were promised before these new rules came in? Nobody knows for sure yet. But what's next? These developments have taken a toll on P2P lending sector's reputation, both as a place to borrow money and as an investment product. With all this trust eroding, it is very hard to say if P2P lending will ever regain all its former glory. But getting on to the real question, what happens now to the potential lenders and borrowers who could have benefited from the P2P lending segment? Look, lenders who once saw P2P as a way to earn good returns may now look elsewhere. But with so many options out there, they may invest in risky and unregulated products like structured credit products, invoice discounting, etc. What about the borrowers? Remember, these are folks who could not get loans from traditional institutions in the first place. While the overall impact on Indian consumers might be minimal, since P2P lending is a 10 to 20,000 crore market as compared to the lakhs of crores lent through credit cards, personal loans, or microfinance institutions, these borrowers still have a reason to be concerned. All of this now depends on whether or not the P2P sector can bounce back strongly from this regulatory blow. For now, though, we'll just have to wait and see how things unfold. That's all the news and stories I have for you today. I hope you found value in this episode. I'll see you tomorrow. Take care and goodbye.